Hi everyone, this is Mrs. V Chen. Welcome to my Form 6 Cost Accounting lesson number 5. Today is 6th of September 2020. Alright, so in today's lesson, we'll look at another difficult example about the difference between absorption costing and marginal costing. Okay, so this is the information about this example. But anyway, what we are going to do is to prepare income statement again under absorption costing and marginal costing, so that after the lesson you will learn more about the difference between absorption costing and marginal costing. Okay, so let's take a look at the information given to us in this example. Now we are given the information from January to March in the first year, and this company is producing one single product. Now here we have the selling price per unit, which is $100, and then direct material, direct labor per unit. And what is the cost behavior for this? Which is variable costs, and direct labor, which is also variable costs. Is that right? Okay, now we come to factory overheads. Okay, I have some mistake here, so it should not be factory overhead, it should be fixed overhead here. Let me change it. So this one should be fixed factory overhead, which is $30,000 per month, and then this is variable factory overhead, $5 per unit, and then here fixed selling overheads and variable selling overheads. Okay. Alright, so and then also we have some other information, so which is budget activity was expected to be 1,000 units each month. So here, alright, I need to work out something. Alright, so we are planned to produce 1,000 units per month. So therefore, what do you think about this fixed factory overhead? If this is fixed total per month, so how much will be per unit? So that will be fixed overhead per unit will be 30,000. Alright, so divided by, just now I have 1,000 units, so therefore that will be 30. So later on I need to use this $30 per unit for this fixed factory overhead. Okay. Alright, and also we have this information for production and sales in the month of January, February, and March. Is that right? Okay, look at January. So how many units produced in January? So we produced 1,000 units, so this is unit produced. And then we have 1,000 units sold, so therefore we do not have any closing inventory. So you can see there is no closing inventory in January. Why? Because the number of units produced is same as the number of units sold. Okay, so next we come to the income statement under absorption costing and marginal costing, and this is the first year in January. So for sales, we have this 100 as the selling price, and this is the unit produced. So therefore, there is no difference between absorption costing and marginal costing for sales. Okay, so this is the information in January. So number of units sold, which is 1,000. Okay, and we have this selling price per unit, which is $100. Right? Okay, now since this is in January and year one, so we do not have any opening inventory, so we just start with production costs, and then we have this all costs. These are variable, not only variable being important under absorption costing, but also fixed cost also important under absorption costing, right? But however, under marginal costing, the purpose is for decision making, so we only concern about variable costs here, and then the treatment for fixed costs will be treated as period costs, because period costs which is irrelevant to decision making. All right, so how about direct material per unit? So I get this direct material per unit as $20 and direct labor as $10 dollars per unit, and then now I come to variable overhead is here 5. So I have 5. So I have 5 here, and then for factory overhead per unit I have 30, and then times. Okay, since this is production, so how many units produced in January, which is 1,000. So that will be 1,000, 1,000, 1,000, and or 1,000. Is that right? Okay, so here I do the same thing. So 20 times 1,000 number of unit produced, 10 times 1,000 number of unit produced, and then that is 30 times 30 times, okay, write it nicely, yeah. So 30 times 1,000 number of unit produced. Since this is marginal costing, what do you think? What do you think about fixed factory overhead will be treated as period cost here? So I have fixed factory overhead because I have no space here, and that would be 30,000. So I have 30,000. Okay, so then we have this 65,000 as total production cost or product costs, and then this is under AC. And here we have this 35,000 is the total product costs under MC, right? Okay, and just now I have a mistake. The variable overhead per unit should be 5 instead of 30, so that I have 5,000 here. If you sum up these three figures, you get 35,000, which is the total product cost under marginal costing. Okay, all right, so absorption costing is for reporting, so that we have sales minus total cost of goods sold. We have gross profit, which is 35,000. Okay, but however, under marginal costing, since it is relevant for decision making, so the all variable costs, okay, will be counted for part of the cost in order to calculate contribution. So what are the variable costs we have? So here we have another variable selling overhead, which is $4 per unit. So I have to add variable selling overhead, and which is $4 times 1,000. So I get this 4,000. Okay, so all together, so what is the total variable costs? That would be 35 plus 4,000. So I have 39. So 39 is the total variable cost, and I have sales minus total variable costs. So 61,000. Remember, we don't have gross profit under marginal costing. We change that to contribution, right? And contribution is equal to total sales minus total variable costs. Okay. So that was left for expenses, which is the period cost under absorption costing. So that let's check. So therefore I have the selling overheads and selling overheads left here. So I have fixed selling overhead, which is 1,000, and then I have variable overhead, so which is 4 times number of units sold. Okay, just like the usual way we prepare the income statements under financial position. Okay, so I have this 5,000 altogether. So how much is net profit under absorption costing in January? Okay, so I have 30,000. Okay, all right, so what about marginal costing here? So what fixed costs? We have fixed factory overheads, and what else? We have this fixed selling overhead, which is 1,000. So fixed selling overhead, which is 1,000. So altogether 30,000 on 1,000, so that would be 31,000. Okay, so how much is net profit, which is also 61,000 minus 31,000, so this is 30,000. Okay, so this is what we have in January, the income statements under absorption costing and marginal costing. So we have the same net profits. Okay, so net profits under AC and then net profits under marginal costing is exactly the same, because what happened in January? Do we have opening inventory and closing inventory? No, we don't have. Okay, there is no opening inventory, and then we don't have any closing, no closing, okay, closing inventory in January. Okay, so in January, since number of units produced is 1,000, and then we sell 1,000 as well, so there is no closing inventory. However, what happened in February? We produce 1,300, and then we sell 800, so we have closing inventory, which is 500 units left, right? Okay, so now we come to the income statements under absorption costing and marginal costing, and now this is in February. Okay, so what about sales? This is the unit selling price times number of units sold, which is 800, and there's no difference for sales under absorption and marginal costing. And then this is units sold, 800 units. Okay, now we come to production costs. We also have this same as before, so this is the per unit, but this time, how many units produced? So this is 1,300. Okay, so we have this, all costs, including fixed and variable, to be treated as product cost under AC, but however, we only have variable cost to be treated as product cost under MC. Alright, so if you use your calculator, you will get this 84,500. So this is the total product cost under absorption costing, and here 45,500 is total product cost under MC. So you'll realize that which one always bigger than the other one. So we have total product cost under AC always bigger than marginal costing, because what is not included as product cost under marginal costing, which is fixed overhead. All right. Okay, so since we have closing inventory, so therefore we have to minus closing inventory. So here we have less closing inventory because we have inventory not sold to the customer. So here we also have closing inventory. I have no space. Okay, and how do we get closing inventory? This is total product cost, so I will have this 84,500. Okay, so what is the total number of unit produced, which is 1,300? And how many unit left? Units unsold, which is 500. So how to get this 500 from here? So this is unit produced and unit sold, so we have 500 unit left. So this is how we get closing inventory. So here, to work out closing inventory, so 45,500, and this is for total 1,300, and then 500 like that. Okay, so I get my calculator. 84,500 times 500 divided by this, so that I have to minus this 32,500. Okay, so how much is here? 45,000 times 500 divided by this, so I need to minus 17,500. Okay, so 84,500 minus 32,500, and then 455,000 minus 17,500. This. Okay, so next we need to do adjustment for this 39,000 being fixed overhead absorbed. So we realize that this 39,000, which is not the same as this fixed factory overhead 30,000, because the meaning of fixed means always the same, remain unchanged. All right, so therefore 39 is being overstated, so we need to do adjustment under absorption costing. So minus overhead absorption of 9,000. How do we get 9,000? Because this is the actual fixed factory overhead, and then if we do that in this way, so this is called the FOH, factory overhead absorbed, being too large, so that we have the minus 9,000. So therefore altogether this is total cost of goods sold in February under absorption costing, and then now I get gross profit, which is 37,000. But however, under marginal costing, so we don't have this problem for fixed overhead because we just treat that as period cost, so that is 30,000. Okay, so now we have gross profit under AC, but we don't have gross profit under marginal costing. We have contribution, and don't forget to treat all the variable costs. So what else is left for variable costs? We have variable selling, right? Overhead. Okay, so let's check the price for selling. So variable selling is $4 per unit times what is important, selling 800 is number of units sold, so that I have 4 times 800. Okay, I think that's about all to get contribution under marginal costing. Is that right? So that I have this 4 times 8, oh, sorry, no, clear. So 4 times 800, 32 plus this, so 31,200 will be the total variable cost under marginal costing, and then contribution, okay, 48,800. Let me check, so which is correct. Okay, almost finished. Okay, so what's left under this for expenses? Okay, finally, so we get the usual expenses. Let's say we have fixed selling, variable selling as usual, so we get net profit, which is 32,800 under absorption costing, and then all fixed costs under marginal costing to be treated as period costs. So we have fixed and fixed selling here, so net profit, which is 17,800. So that you can see in February, the net profit under AC and MC, they are not the same. All right, and which one is bigger? So net profit under AC is bigger than net profit under marginal costing by 15,000. Now we try to explain. Now we are going to explain why this is not the same. So because the closing inventory under absorption costing is bigger than closing inventory under marginal costing. Okay, why is it so? Because all costs, including variable costs and fixed costs, will be counted as product cost under AC, but we only have variable costs to be counted as closing inventory under MC. So what happened to closing inventory? If closing inventory is bigger, then cost of goods sold will be smaller, right? So cost of goods sold under AC will be smaller, so that what happened to net profit under AC and then net profit under MC? So here, smaller cost, then net profit will be bigger, right? This will be bigger, and the difference is 15,000. And then you can check. So what is the difference between this 32,500 and 17,500 for closing inventory? So get 32,000 and then minus this 70,000. See, which is exactly 15,000. So I can write because of closing inventory under AC, which is how much? Which is 32,500, and then closing inventory under MC, which is only 17,000. So the difference is exactly same as 15,000, and 15,000 is exactly the difference between net profit under AC and MC. Okay, finally, we can use another way to prove this 15,000. The major difference is due to we have closing inventory, which is 500 number of units, and then times. So what is not counted here under marginal costing? So the fixed is not counted. The fixed is counted here, 30,000, but the fixed is not counted. Just like the diagram here, the fixed is counted under absorption costing, but the fixed is not counted. So how much is fixed overhead per unit, which is $30. So altogether, so that is also 15,000 for the difference between closing inventory, and that explains the difference between net profit under AC and MC as well. Alright, so here I have the formula of cost of goods sold, which is opening inventory plus production costs and then minus closing inventory, so that I get this 71,500. But however, this is under absorption costing. We need to check this fixed overhead absorbed, which is 27,000, which is not the same as the fixed overhead here, 30,000. So that I need to do adjustment. Okay, and this is understated, so I have to add back this called under absorption. Okay, so how much I need to add back? So the actual one is 30,000. Okay, I need to work out the difference, so that is minus. Okay, so that is 30 times 900. Okay, so the difference is 3,000 for adjustments of under absorption. Okay, so that will be 71,500 plus 3,000. I have 74,500. Okay, and then the gross profit 35,500. Okay, so before we work out contribution under marginal costing, don't forget to include all variable costs. And then we have variable selling overhead. Okay, so check how much per unit, which is $4 per unit. So $4 per unit times, now be careful, it must be times the unit sold, which is 1,100. 1,100. Okay, so 1,100 times 4,400. So add 38,500. So this is my total variable cost under marginal costing. And then contribution is total sales minus total variable cost, 67,100. Okay, so here we come to the remaining thing to work out net profits. So this is fixed selling, variable selling as usual under absorption costing. So we get net profit, which is 30,100, and then only fixed costs will be treated as period costs, so that we have this 31,000 as total fixed cost, and finally we have net profit, which is 36,100. But this time, which one is bigger? The net profit under marginal costing is bigger than the net profit by 6,000. All right, so okay, so here is the reconciliation. So under absorption costing, marginal costing, so we have both opening inventory and closing inventory. So this one, opening inventory, is bigger in AC, bigger than MC, so by the change here. And then we also have closing inventory this time. Okay, the closing inventory is 9,000, so the difference here, 6,000, explain the difference between net profits under absorption costing and marginal costing. So this is all the things happens in March. Okay, so finally we go back to the situation in January. So in January we have net profits under absorption costing and marginal costing. Under what situation we have the net profit being the same? When there is no opening inventory and no closing inventory. Okay, so that's all about lesson 4. Right, so thank you for watching. We will do some more DSC questions in the next lesson. Alright, so see you next time. Bye bye.